Welcome back to Tax Reform India channel. Today I'll be covering the 6th session under Why Tax Reforms Are Critical series. My name is Bharat and let's get started on this interesting journey. Previous session was about clearing national debt position through DDT. In session 6, we will be leveraging other bank transactions into the taxation framework. I highly recommend you to please complete previous sessions to make this a relatable session. Let's begin with cash transactions. They form nearly 25% of the total transactions. Heavy cash transactions can lead to an increase in black money and corruption, and that's the sole reason why demonetization had to be implemented. If DTT is at 1% for taxpayers, then levying a 4% tax on cash withdrawals would be a very appropriate taxation proposition. Now, digital transactions come with a certain limitations. If you are a merchant, you can't indulge in a transaction of more than 5 lakh rupees, and if you are a buyer, you cannot indulge in a transaction more than 1 lakh rupees, most of the transactions. Digital transactions form nearly 60 to 70% of the total transactions in volume. Now moving on to check or DD transactions, they form nearly 10% of the total transactions. Even though they are less in transaction footprint volume, they are very high in value as they are extremely heavy transactions. If you noticed Shark Tank episodes, they would strike a deal with an entrepreneur by signing a check. They would never indulge in Google Pay, Phone Pay, or any other UPI app for acquiring stake in the entrepreneur's organization. Bringing a check or a DD transaction to a taxation framework at 1% will make a very significant difference to the tax revenue. Now speaking about heavy loan component taxation. How should heavy loans be taxed? What is an appropriate way of taxation? Our proposal is, when you take big loans for car, education, personal and home loan purposes, taxing the principal amount would make it very unfair. Hence, we are proposing taxation only on the EMI component. When the applicant starts paying EMI, that time levying a transaction tax would be appropriate. And this whole intention is to save the principal amount of taxation. If the loan is 50 lakh rupees, it is not appropriate to tax on 50 lakh rupees when the person has to still pay the EMI. Now here is an insight that is important for a taxpayer. Over 100 crore bank accounts indulge in digital transactions. Now that is our digital transaction footprint. Now if we bring all banking transactions, including the digital transaction tax, under taxation, then we would call it bank transaction tax. And bank transaction tax is a component that was proposed much earlier than digital transaction tax. However, there were no supporting documents or supporting evidences to showcase the impact on the value of bank transaction tax. Whereas in digital transaction tax, we could actually take government data and show how much of revenue growth we can offer in comparison to the existing revenue collections. Stay tuned for the next session, where we will come up with more insightful sessions. We encourage you to share this video if you found this useful. We encourage you to comment below the video if you have any doubts on this session. Please feel free to hit the thumbs up button if you really like this video. And lastly, please don't hesitate to subscribe to our channel, and we promise you more insightful tax related sessions, and we are very sure you won't be disappointed in this. Thank you. See you later, and Jai Hind.